Samuel, I'm hoping that you had part of the news that came through. The World Bank is downgrading its Kenyan growth. We know there are issues around inflation. We know interest rates have been rising. And at the same time, we also know that foreign participation in the Kenyan market has been coming off. It doesn't look like there is any rainbow for the Kenyan market. Or are we missing something here?
Yes, I think, well, at least we still had some growth. I was a bit worried on that bit. But I still agree that the market is looking rather bleak for now. We're seeing a lot of bargain hunters coming in. Most of the high net worth, clients who have some disposable currency, I'm seeing looking to start taking positions and accumulating. But they're all looking at an 18-month or so time horizon, because right now I think the short end of the yield curve is actually where most of the returns seem to be, and we might see a bit of a flight of capital.
Absolutely. I mean, I'm looking back at your background there, and it's looking like a beautiful day out in Nairobi, but on the market there is blood, particularly on the banking sector, because I saw yesterday some of the bigger banks coming off, CFC in particular, down, I think, more than 5% on the day. What is the market pricing on the bank stocks? Are we likely to see some more interest rate hikes before things get better?
Well, I think with the banking stocks, that is where most of the worry is, because we are considering the fact that, for example, most banks have had to renegotiate their loan repayment schedules because of the increasing interest rates, just to ensure that they don't have an increase in defaults going forward. And I think that for one is informing the fact that most investors are seeing a slowdown in the growth in the banking sector, which naturally signals the fact that we do expect the market to remain on the low note, at least up to, say, H1 2012. And then after that, we have again coming up the elections, which again usually has an adverse effect on the market. And so I think most investment analysts are going to be downgrading the banking stocks for now.
Yeah. So is the market pricing another interest rate hike from here on? And if so, what percent, what quantum are we talking about here?
Well, I'm expecting that we could see another 100 to 150 basis points interest rate increase on the CBR, and that, of course, will push bank interests, lending interest rates, say, a little higher by 1 or 2%, I would expect. And I think that is going to really hit on growth. It's going to hit on borrowing. It's going to hit on loan books, and loan loss provisions will have to go up.
Yeah, it tells you that things are dire when you begin to celebrate a gain of 0.03%. The headlines coming out of Nairobi yesterday saying the market was breaking a month-long slide, and we had that gain of 0.03% on the NIC 20. And, many phrases come to mind. Are we talking about a dead cat bounce here?
Well, I think we are going to see a flat market. For now, it's holiday season, man. So basically, I don't expect much activity between now and, say, after January, after the kids are back in school, and maybe after the first 1-2 months of 2012. I expect the market to remain flat.
So if you were a careful stock picker in this market, surely this should be a bargainer's market, a bargain hunter's market. There must be pockets of excellence and value showing through the market now. Maybe give us your top 5, Samuel, if you could.
Well, right now I'm looking more on those stocks or those companies that have a defensive nature, and those stocks that have very strong asset basis and very strong market share, because for them their earnings will tend to remain quite good, and their asset quality is quite strong. So KPLC comes strong fast. I'm looking at Carbasid, which has a 95 to 96% of the carbon dioxide market in the country. I'm also looking at a bit more towards energy. I'm still not a bit skeptical about Kenyan, but Kenyan could also come in strong. But right now, they really need financing. They really need the cash to invest. So investors will not be seeing much of a return coming from those.
Right.
But on the banking sector, I'm still banking on those locally ran big boys, which is KCB and Equity Bank. Interestingly, they have a good regional footprint, and they have continued to show growth. And I think that despite the fact that they might see difficulties in their loan books, I do expect that I would be buying those and waiting it out.
But why would you be picking the locally owned, locally ran banks as opposed to those foreign owned? Or majority foreign owned?
Basically because we have seen in the past that in as much as during bad times, the foreign owned, foreign run banks tend to do better in bad times. That's because they're very conservative and they tend to chase growth. The fact that the locally owned and the big boys like Equity and KCB have invested heavily in the SME sector, and when growth does come, they really, really gain very heavily. They have, for example, Equity has a transaction-based model which really gives them strong earnings in non-interest income, and so that would be one of the reasons that I bank on them, and the fact that their decision-making process is very efficient.
Okay, let's move away from the market and its depressing news, but hopefully you have highlighted some pockets of value there. Let's talk about some of the headlines that we saw coming through from Nairobi today. One of them is regulators working on a plan to make cross-border trade possible. They're talking about the establishment of an inter-depository mechanism. How feasible is that, number one? Number two, how desirable is it amongst the investment community in East Africa?
Well, my feeling is that we have a lot of regulatory hurdles to go over. We are operating on markets, for example, that are on different platforms. And I think that unless we have the right regulation and we have the goodwill from all the participants, we are going to see another long drawn-out battle, long drawn-out talks like we have seen with the common currency, which again I am not very much in favor of at the moment, and until all the economies are actually stable, and once we have seen all the lessons that we can learn from the Eurozone crisis.
Absolutely, I tend to agree with you. They're talking of 2012, and I know when I came there in 1998, they were talking about a common market for East Africa. A decade later, I had left, and there was still no common market, so that one, let's shelve it. Just one quick story, Samuel. The Ogilvy CEO selling his stake, part of his stake in Scan Group, and the story for me is that he is selling. He had a 1 to 4 year window during which to sell, and he is selling just after a year. What are we to read into this?
Well, we have seen that actually happen to the lock-in for Cooperative Bank and Equity Bank, and now again Scan Group. I haven't seen the story particularly, but I think that for these big holders of company stocks who are mainly in management, it is not really a matter of the fact that they have less confidence in the companies, but more of looking for new areas to invest in. One, we know that they are very good investors. They know how to pick very strong growth investments in the past. If they banked on what they have built in the past, then they are the type of people who are always looking for somewhere new to put their money, which would give them the sort of growth that gives them the exciting returns. And I believe that that's what they are doing.